Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, November 7, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, we have another pretty decent size up day. The ES or the SPX, for example, was up 44 points, and the SPY was up about $4.50 or 0.75%. Pretty decent up day. We call that in the trading parlance follow through from yesterday's really big up day after the results of the presidential election here in the U.S. We're still on what we call in the trading parlance the Trump pump. We have a bit of euphoria in the way. It's a bit of a runaway market. Maybe it runs away through the end of the week. Maybe it doesn't. But I just want to point out a few things that I think are important so that we can all put things into perspective. For one, she's getting a little bit extended from home base. Obviously, she can get more extended from home base, being the 20-period moving average. But net, when she does get extended, and use the history on the charts as a guide, how far does she really get when she gets above by much the 20-period moving average before pulling back or going sideways, giving the 20-period moving average a chance to come back to price? And we're in one of those areas now where she's getting a little bit too far from home base, so we should be expecting a down day coming, a couple of down days coming, a corrective move coming. Something like that is coming. Whether it's on Friday or whether it's into next week remains a mystery, but it is coming sooner than later. Same thing applies to the weekly chart. Above all the moving averages, the trend is certainly your friend. However, she's now getting a little extended from home base, being the 20-period moving average, and you look at history as a guide and say, when she does get extended from the 20-period moving average, how much is the extension on what we'll call a maximum basis, right? There is no such thing as a minimum or maximum in the markets. It could go anywhere at any point in time, but just using history as a guide, she doesn't really get too far from home base. Well, we're in that zone right now where we're going to be expecting, ing in italics, some kind of a pullback sooner than later. But wait, there's more. There's supporting what's called documentation. First of all, when the market's in a runaway situation or in a perpetual downtrend or bear market where it goes down every day, never looks like it's going to turn. When it's gone straight up, it never looks like it's going to turn until it does. So we all understand that. But here's something else that you can chew on over the next couple of days. We have what's called symmetry in the SPY weekly chart. It's something that I teach in my course, Lazy E-mini Trader, and it will certainly look more like symmetry if this candle here, well, I didn't want to use that tool, if this candle here ends up to be an ending candle, ending of a move, similar to this candle here that was the beginning of another move. You have symmetry there, and what you also have is, and get ready for it, wait for it, are you sitting down? It's an on-time type of situation on a weekly chart. So could we be having somewhat of a blow-off-ish situation on the election results with market symmetry in an on-time situation on a weekly basis? Chew on that one for a while. How do you like dem apples? Here's a discussion that we had in the live room today. I believe it was today. And you just take a look at life in general and things that comprise our lives, whether it's our job situation, our business, whether it's a family situation. It applies to the market. It applies to everything. When things seem really good at the time, they're probably not as good as they may seem because we have short-term memories and human nature to have short-term memories. So we recall the last set of things that happened really, really good. Or on the flip side, mirror images, things could be really, really bad for a while, go through a tough time, whatever the situation is, and it gets worse and worse and worse. And then you have to think in terms of, well, there is a thing called the darkest before dawn, when things seem really, really terrible. Maybe they're not so bad. Maybe they're ripe to turn around, and it never seems like it until it does. Well, when we have these blow-off situations, and I'm not saying just yet we're in the midst of a all-out blow-off situation, but when there's a rally on a news event that lasts for a few days, it's usually a little bit overblown. And when I think about those things from a logical perspective, and I couple them with what I find on the weekly chart from a technical perspective, I can't help but think logically that, hey, you know what? It makes a lot of sense that within the next several sessions, it's likely the market's going to put in some kind of a turn, and we're going to have some kind of a corrective move, because that's how it works. Whether it begins tomorrow or sometimes next week, I think that's what we're looking for. We're looking for a top. Doesn't have to be a final top. It doesn't have to be an all-time top. It doesn't have to be a top for months and months and months. For now, we're looking for a top. Let them correct 100, 125 handles in the S&P. They'll still be above the 20-period moving average. They'll still be above all the moving averages, and the trend at the time will still be your friend, and that'll be a scary day or two in the event that it happens like that. We've seen it many times in the past. Whether that's the beginning of a bigger correction or not, we'll deal with that at the time. We don't need to know that now. We don't even have a top in place, which leads me to something else that's taught in the course, Lazy E-mini Trader. What are we looking for, at least from maybe a daily chart perspective, maybe a 4-hour perspective, a 2-hour perspective? We're looking for signs and or signals of a trend change. There are several, and we put them together with all this other bucket full of stuff we're talking about, and it gives us as traders and investors something to trade against. Because if we're going to be wrong, might want to get out your sticky notes. You want to be wrong small and fast if you have to be wrong at all. And in this business, I know it's going to come as a shocker, but we are wrong from time to time. What about inside the numbers? What happened today inside the numbers? Was there anything material that were in the notes? Well, all in all, the short answer is not really. We even had a Fed day, which I haven't even mentioned yet, and the market still went straight up. The Fed cut rates by another 25 bips, or 0.25%. It was built in or baked into the cake, as they say. What do I mean by that? The Fed already told us that was in the plan, and therefore, the Fed's not in the surprise business. They're not in the surprise party business. They're in the telling you what they're going to do and doing what they told you they were going to do business. They've been like that for years and years and years. We were all prepared for a shakeout operation if, in fact, the market did have a morning shakeout, but she didn't even do that. It was simply just another up day. What I urge you to do as I go through the notes, I'll point out a thing or two that was important. What I urge you to do is pause the video, read the notes, go back to the chart, and double check the work. Basically, what we had early on today was 594 to 595 as a resistance zone where they should not be able to waltz on through and should have a pullback from. I know this is difficult to see. Right of the vertical is today's activity. Here's a 5-minute chart at today's market. You could see the narrow ranging uptrend all day. It was, in fact, a trend day up. But here's the thing. There's 594 and 595, the blue lines across the board. You could see where there were overhead resistance and the pullback, and this was the extent of the pullback. So dollars for donuts, painting by the numbers, you short one, you short the other. They gave you a tiny little trade out of it, and then they went right back up to 595 or the top end of the zone, kind of hung out there for a while. So it's a no harm, no foul. They just didn't really react from a resistance zone, and we were just in float mode. We're still in the Trump pump. As you could see, there was not a lot of other activity on the tape today. The market was flat-ish, just in a grinding, trending, narrow-ranging, chop-shop-ish formation-ish. What about stocks on the move? We had three possibilities on the board today. We had Match.com, CTVA, and ARM Holdings. ARM and CTVA didn't do the deal. They didn't reach their entry objectives, but Match did. So let's take a look at that chart. 5-minute chart of Match. You could see they're getting a buzz cut at the opening bell. We had our zone 3202, 3145, and even 3069 later in the day. You can see where they bounced off that, but they gave you the deal here. Even if you go down to a 1-minute chart, you'll see that they did the thing right away. They spiked the first number, ripped it back up in the other direction in the first minute. Then they came down to the second number, ripped it back above the first, gave you 2 trades if you wanted it. Any way you slice it or dice it, Match Group did the deal. The numbers work. What's going on over in Camp IWM? Well, they were on a stall-out mission today. They were up a little bit. They were down a little bit. They finished down about 1/3%. No real harm. But we will note, it is of note, puzzle piece on the table, that our favorite market leading indicator was not participating with the S&P on the upside, so we will note that. The only trouble that'll come into play, for example, leading into the weekend or next week, will be getting below yesterday's low at 232.75. You get below 232.75, and that opens the door for some stuff on the downside, and you would be in the midst of a corrective move, likely across the board. Similar to same routine on the weekly chart for Camp IWM. You're getting a little bit extended from home base, the 20-period moving average. Not to say they can't go higher, and they can. But once they start to get a little bit farther than the norm, and the norm you use history as a guide, then you start looking for signs and or signals of a trend change from smaller time frames. Things will morph from smaller time frames onto larger time frames, and you get the big picture from the larger time frame, and you apply what's going on in the big picture down to the smaller time frames so that you can affect trades and investment decisions. How do you like dem apples? This is some big weekly candle. In the trading parlance, we call this one a boner candle. Now, what about the folks down at the transportation department on a give back today of about 250 points? 1.5%, 1.4%. Now, yeah, granted, they were up a whole lot more yesterday, so this is just a partial retracement. However, not participating on the upside with the S&P is interesting. It is a divergence, just like Camp IWM. So therefore, what do we have? We have two things. We have my favorite market leading indicator, the IWM, down on the day when the S&P was up. And we have thing number 2, the folks down at the transportation department, my second favorite market leading indicator, down on the day, a number 1 canary in the coal mine, down 1.44% today, S&P up almost 0.8%. Interesting information. Puzzle piece on the table. The other thing to keep in mind, as this thing is in an uptrend, again, extended, yes, this is the transports, but an uptrend nonetheless. The high over here, this is the all-time high, 18,246 and change. So are they going to challenge that high, bust through that high, come up short of that high? We don't know the answer, but it's just information. You need to know where the former high is relative to where the index is at current time. What about the Q people? Same routine, and the Q people up $8 today. Healthy up day, 1.5%. They were kind of leading the charge, if you will, busting out to new highs. We talked about that last night. You see them on the weekly chart. It becomes much more clear what's going on. So let them go. Maybe they run up into the end of the week, but once again, just like before, they will start to get, and I don't think they are just yet in the Qs, but they will begin to get a little bit too extended from home base. They may have a little more juice in the tank, but then at some point, what's going to happen? Repeat after me. They're going to come back down to retest the former breakout area at 503.52. I would write that down and put it on a sticky note. There's an anomaly for the day. How about the financials? The XLF getting a little bit whacked today, down 1.6%. In case you're wondering, they did not, and I repeat, not close below yesterday's low. Yesterday's low is 48.70. Today's close, 48.75. There are no accidents or coincidences. They may close below there tomorrow, but it's still a down day in the financials on a day when the S&P is up. I will note that it's a puzzle piece. It's another puzzle piece. It's on the table. We're starting to put together the picture, the pieces to the puzzle. We have my two favorite market leading indicators down on the day, IWM and the transports. The financials were down, teetering with yesterday's lows. That's interesting information. So I look at these things as canary-ish. Again, not everything reacts and acts at the same time. Sometimes they give you flares up in the air. They give you warning signs ahead of time. I think we may be seeing some warning signs. Heed the warning signs. And what do you know? Smash Mouth, the SMH, played some catch-up today on the upside, up $6.21, 2.44%. And what they're doing is now running a test in the vicinity of the high of the breakdown candle that we've been watching for a long, long time. So they played some catch-up. They didn't do it on Trump Day. They did it on day 2. Get above the high of this breakdown candle, 262.11. All bets are off for the downside. There will be some energy released in the upward direction. That will be overhead resistance, first time, best time. They kind of came close today. Maybe they gap above it. That's one way to get through rather than having to grind. That's a trader term, grind through there during the trading day. Time will tell. We'll see how the week closes on Friday tomorrow. A lot of weekly charts waiting for the weekly close. By the way, in case you're asking the question, let's say the energy was released in the upward direction and this big $14 down day gets negated. What kind of energy are we talking about? How much higher is the SMH likely to go? And if they're going up that much higher, isn't it likely that markets, other markets, are following suit and having a rally as well? And the answer to all that stuff is yes. And the number is right around 272.50, give or take. Write that down, put it on a sticky note. In fact, there's a gap just a little higher, so while the number may be 272.50, you can say here's a gap, closing print 273.71, so they would likely go up and fill that gap. That's what I'm saying. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.